Hey, hello, hello. Are we live? Are people here?
We
Okay,
are.
there you are.
We are live. We got Mr. Naugle. Can you hear me? All right.
Yeah, now I can. That's the goofiest thing I've seen in a long time. That
Well, the
that
good,
studio always works.
well, the good news is you got multiple studios. So it's like, hey, if one
Yeah.
doesn't work, you go to the next. Aloha
Oh,
from
first world problem, I suppose.
Hawaii. That's right. All right. Aloha from Hawaii. Let's see where our audience is at before we get started here. Give us some shout outs, cities or countries, probably not countries. Illinois. All right. I lived in Schaumburg when I was a
St.
kid.
Louis.
San Diego.
South
I see a
Carolina,
lot of
San Diego,
clients.
Vegas.
That's awesome.
Wow, I like it. I'm all over. Chris,
Did you win the Super
I know
Bowl?
you're not a big football fan, and Claudia hates when I talk about sports, but I mean, I have to bring it up. Are you,
Dude,
how,
wide right? Are you kidding me?
are
Scotty
you
Norwood
okay?
kicked wide right. I'm fine. I mean, listen, I get to go snowboarding and I don't have to leave snowboarding to watch the game anymore, but it sucks. I mean,
Yeah,
we had that game. First, we just had that game, and then we are cursed.
Buffalo.
We are cursed with kickers, man.
Chris is in Buffalo. I'm sure some of
Theo
you
said
know
had
that.
the game.
Yeah.
Oh yeah, it was a rough one.
Yep. It was I assume things are okay, so you weren't over there shoveling snow to get the fans in their seats, right? You weren't one of those
Dude,
people.
I'm not going to that stadium. I'm not jumping on tables. Like, I don't know. I don't love the sport that much. I enjoy watching it. I just don't love it that much.
Well, you were probably really happy because like you said, the snow was filling up in the mountains, so you can go
Yeah.
snow.
And now we're getting rain, so go figure. Now it'll probably all melt.
Well, let's go Chiefs. All right. Okay, we'll stop on the sports because Claudia will get mad at me going too far on the sports. She's like,
I'll
everyone
let
doesn't
you
like
gentlemen
football.
take it. I will be back in a little while.
All right, all right. Thanks, Claudia. Let's get started. It's 4:05 Pacific, 7:05 Eastern, and let's jump right into this. And so look, I'm super excited today. There's a I've done a lot of webinars recently in the last probably 4 months, and I'm really excited about this one in particular, because I feel like, and don't take this the wrong way, I get to introduce a very good friend of mine, Chris Naugle here, but hopefully you don't take this wrong. But I felt like I was like, you know, the mentor to Chris Naugle back in the day, and now it's like you teach the student, and now the student's teaching me, and so I'm not jealous, I'm proud, and I feel like, when you're like, hey, look, I got to go to one of my 3 studios or 4 studios, it's super impressive. But look, I want to introduce Chris here, and I got a few things prepared as well for the audience. I know there's a lot of people listening on YouTube on live, but also are going to hear this recording after as well. Everything's being recorded. So I want to mention also before we get started that I got a gift at the end of this presentation. So stay on to the end, and we got a gift for somebody here, and it's got some really good information. I think more than anything, the gift's going to be getting to hear a bit from Chris Naugle, and I'm just honored to have him here today. And I as always want to say, I before we get started, I'm sure we have the slide, but I'm going to preface it right now. As an owner and founder of Horizon Trust Company, we are not a fiduciary. I don't make investment advice. And talk to your legal attorneys and CPAs and whoever you need to talk to, your professionals. We just want to give. We want to give as much content and education as possible. There is no hard sales pitch at all, which I think is important as well. Our goal is to educate and teach, and hopefully you hear something new that will motivate you to do something different. And I know what that difference that Chris and I always talk about from a different perspective is taking back control of your money. And Chris and I tell that story a bit differently. We do very similar things, as far as taking back control of our money, but kind of different vehicles. And I'm going to talk about that. But before I get going, let me introduce you, Chris. Chris, give us a little background about yourself. I'm not going to jump into self-directed IRAs quite yet. I am going to jump into it a little bit. I have a slide prepared for you that you don't know about today. But before I surprise you with that slide, Chris, why don't you do a little introduction on kind of who you are and why you are the money mentor. So what does that mean? Who are you? What's important to you? Give us a little intro.
Yeah, I mean, at the root core, I'm just a normal guy. I didn't grow up with anything special, anything different than the majority of the people that I speak to when I teach. I grew up in a lower middle class family with a mom that just allowed me to dream, and that's really all I've ever been. Is I've just been that guy that's got the idea, that worthy idea in my mind, and I just never let anything ever stop me from that. And early on, that idea was to be a pro snowboarder. And being from Buffalo, yes, we get to snow, but we don't really have altitude here. It's not like we have mountains. So when you tell people you want to be a pro snowboarder when you grow up, you kind of get looked down on. They start saying, "Kid, grow up. You live in Buffalo. You can't do that here." But I did it. And I can tell you, like, the secret sauce, it's not secret at all. It's just you do what everybody else is unwilling to do. And that's all I've ever done. Like, I've literally just made a career out of, just doing what everybody else was unwilling to do. And I don't care if that was in the snowboarding field or when I started my first retail store, Fat Man Board Shops, in November of '94. It was a very new concept, a very risky concept, but I just wasn't willing to give up. And then, I hit some hard times in the early 2000s when the dot-com crash hit. I had my stores going. I was a pro snowboarder. I was literally living a fairy tale world, if you will. I was living my dream. Pro snowboarder, had 2 retail shops selling skateboards, snowboards. That's what I did every day. Came to work in a hoodie and a beanie, and that was my life. And then when the recession hit, it was the first recession I really witnessed and felt. And that forced me to get back into work. So I ended up having to get a job, and no one was hiring during a recession except for Wall Street. I had a resume that fit on one page. That's how much knowledge and education I had, is it fit all on one page. Pro snowboarder, retail shop owner, entrepreneur, anyone hiring. And Wall Street came a knocking. So that was when I entered Wall Street as an advisor. That would have been 2003 when I first got in. And I saw an opportunity there. I mean, you've seen the movies, Wolf Without Wall Street, all of them, the bullpen. I was in the bullpen. And when I'm there patching calls through to the guys in the outer offices, I just started to think to myself, what do I got to do to get one of those offices? And I watched their patterns. They'd get there right before the bell went off. They'd leave for 2-hour lunches, and they'd be gone by 5 o'clock. So I started getting there at 7. Got all my work done so that when the bell rang, I was focused. And then during lunch, I pounded the phone and made my own appointments. And then after they left, I went out and saw clients at their kitchen tables. People are like, how did you become number 3 in that firm? I did what everybody else was unwilling to do because they wanted to go home, and I just worked. I just did the hard stuff. And, there's so many other things that, I got into real estate because during the Great Recession, when my financial business tanked and my retail stores were in the toilet, I had to find something to do. So what did I do? I watched my wealthiest clients, and what were they doing? Buying real estate. So I started buying real estate after 2008, and I bought them pennies on the dollar. And that was my entry into apartment buildings. And then we went into flipping, and I got to see Tarek and Christina. You remember those days. This is when I met Greg. This is back 2014. And I was starstruck. I saw these guys that I saw on HGTV on the stage speaking, and me and Larissa are in the front row watching this. And I just kicked her. I said, Larissa, if we're ever going to get on that stage, we got to have our own show. Another worthy idea in my mind. We got to create our own TV show. And I knew nothing about it, but I went after it. And lo and behold, like, when you don't let up on thinking about something, when it consumes you, the only thing that can happen is what your mind makes happen. And that was a show. We got our show in 2018 on HGTV. And listen, real estate went a different path. We flipped 274 houses in our time. And this is the unique piece. This is the most critical piece to my whole story, is that's when I met Greg, and I'll never forget it. Greg and Mike on the stage at that same event. And I hear Greg talking finance, and I was an advisor. So I'm like, oh, this guy's a money guy. I got to listen. And he says, the ultimate in real estate is being the bank. So when he says he was my mentor, he was the first person that planted that idea in my head, be the bank. I had no idea what it meant. I literally thought, all right, I got to flip enough houses, make $1 million, and then I can be the bank. So wrong. But that's what got me into this. And, there's a lot more to the story and the people that I've met. But again, it's just a worthy idea planted in your mind that you never stop thinking about, that you never stop going after, and you just keep improving on it. And that's my story, man.
Well, look, there's a lot. In fact, we could probably go on for hours. We're not going to, don't worry. But there's always about half our audience that is brand new to our subject that we're going to talk about, and then the other half are either clients, mostly clients, really, the other half. And so before we dive a little bit deeper into the money side and how money works a bit, I want to just I want to share with you that. In general, for those that are new, Horizon Trust Company is the company that we own, and that we help thousands, literally thousands of clients take back control of their retirement funds. And what does that mean exactly? As Chris knows, and Chris is definitely a client, and we're going to get to that soon. But basically, if you're listening to this and this is brand new to you, and I know there's a lot of, I recognize some of these names here that have listened to both you and I before, Chris. So I apologize if it's a little bit repetitive in the beginning, but if you're listening and you have a retirement account, an old 401k from a previous employer, or an IRA, and you're looking to invest in something that you want to take control of, in real estate or Bitcoin, precious metals, almost whatever you want, this is the right call for you. I am a big proponent on taking back control of your money. Nobody cares more about your money than you do. And we're going to talk about two different vehicles. The first vehicle is the self-directed IRA. So any one of you that has an IRA, you actually can control it. Since the 70s, this has been out and it's legal. The IRS approved it in the 70s. You can take control of all or part of those monies and open up a self-directed IRA account, which thousands and thousands of people have done with us at Horizon Trust Company, meaning you can move over your funds and invest it how you want and what you choose, rather than the list of options that might be in the stock market. So first and foremost, I wanted to at least preface that because we're going to talk about self-directing, and when I say self-directed as well, again, since it's new for some people, it's not a type of IRA. Like a Roth is a type of IRA, or a traditional, or a SEP, or simple. Basically, it's a descriptive term, and it's used in front of that. So meaning you can have a self-directed Roth, a self-directed traditional, or simple, or SEP, or self-directed 401k. It just means that you are in control of making the decisions on behalf of your retirement account, rather than somebody else or some kind of fiduciary. And so that's what a self-directed IRA is. I've got a couple slides that I might share, actually, that I'm going to share because I know Chris is part of those. But before I do so, I also want to share something that has been near and dear to my heart that Chris has introduced to me in a major way. And Chris can go on for about an hour about this, but maybe do like a 5-minute or a few minute elevator pitch on the infinite banking insurance policy that takes back control as well of people's, if you're wanting control of money. And I'm not going to try to do it as good as you do. So Chris, do you mind explaining kind of what you do for literally thousands of individuals every single year? And it's definitely different than self-directing. And we're going to talk about how both those things are different, but do similar things. I'm going to explain the differences after Chris kind of explains a little bit about being your own bank. I saw someone put BYOB, and talk about that just for a minute. So go ahead. Why don't you just share real quick the infinite banking side that you do for your clients?
Sure. And I love it. A couple of people like Sean saying Nelson Nash, BYOB. But I mean, when I say the word infinite banking concept, what is the first thing that comes to your minds? Put it in the comments right now. I just kind of want to think about what most people think about when they hear infinite banking concepts or be your own bank. Because so Billy said IUL, which that's not the answer I was looking at. IULs absolutely don't work for infinite banking, but let's just think about it. They're mostly going to think about a product. Okay. They think infinite banking concept is a product, typically, especially designed whole life, which is the baseline of what the infinite banking concept is run on. But I got some news for you. The infinite banking concept is not a product at all. It is a process, true and tried process. It is a process of taking back the banking functions in your life. So when I say that, I don't know what everybody thinks, taking back the banking functions in your life. Now, let me explain it, and I'll do this very simply. Take all products away. Take whole life away, IULs. I don't we don't even talk about those, but let's just do it from a bank account. You want to take back the banking functions in your life. First thing you'd have to do is you'd have to go out there and take the money that you earn and save some of it. I always say the 10% rule. It's the first law of wealth, 10% of what you earn. So if you make money, we must save some of that money. So we're going to save that money. It's got to go somewhere. Okay. Most people would use a bank account. Now we got money in the bank account. Now let's think, what happens to the rest of your money that you have, the money you didn't save? It goes to bills. It goes to debt payments, right? Most people, and I can tell you almost all people, have credit cards today because the credit card debt just peaked over $1 trillion. Big problem. But you got credit cards, and every month you make a payment on a credit card. You are giving up control of money that you worked for, and you're giving it to a credit card company, a bank, and that is mostly interest that they're charging you. Can anyone tell me in the chat right now what your credit card interest rate is? Is it 15? Is it 20? Is it 29? Those are all big returns, right? Now, think about those returns, 15, 20, 29%. What if you had a place where you could earn 15, 20, 29% return on your money consistently every year without ever missing a beat? Would that be a good investment? Would that be a great place to put your money? It'd be the best, right? You'd be like, holy crap. But you all have that. You just said that you have a credit card that you pay every single month, and that credit card charges you a high interest rate, double digits. So you want to take back the banking functions in your life. Great. You take the money that you've been saving in that savings account or that bank account. Okay, we're just using a bank account. And we're going to take that money, we're going to pay off the credit card. We no longer owe the credit card, but you got to then think like you are the bank. So if you're going to take back the banking functions, well, you can't just pay the credit card off and call it a day. You got to take the money you used to give to the credit card out of your income. Let's just call it $100. That represented 29% interest, that $100 payment you made. You're still going to make that $100 payment, but you're going to make that $100 payment back to yourself. That $100 every month that you used to give to Visa, you no longer owe Visa because you paid them off with the money you saved. You're now going to take that $100 and you're going to put it back in that savings account every month. Same thing. What is your return on that? Your return is exactly the amount you were paying the credit card. If it's 29%, that's a 29% return guaranteed because you were just giving that money away before. Now, that is how you take back the banking functions in your life. You do that with credit cards. You do that with car payments. I own lots of nice cars, and Greg does as well. And the one thing I will tell you is for every car that I own, I get every dollar back for all the cars that I buy, drive, and own. Why? Because I changed one thing, folks. That's it. I did one thing different than you. I learned this. And that one change is where my money goes first. I don't put my money in traditional banks because when I put money in a traditional bank, the bank is in control of my money. You don't believe me? Try to tell the bank that you don't want your deposits to be lent out to specific people, and they'll tell you, go fly a kite. They're in control of your money, not you. I put my money the same place the wealthiest families in history have, the Rothschilds, the Rockefellers, Walt Disney, Ray Kroc. I mean, I could go through them all. And that is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Now, why would I use a whole life? Why wouldn't I use a bank account? Remember that circle, okay? All I want you to do, folks, just think of this. There's a circle. Our money starts on the left side of that circle, whatever that is. I'm choosing my left side, my holding tank, to be a specially designed whole life. Why? Because whole life pays a guaranteed interest rate. I get dividends every single year, as long as they declare them, which they've never missed one. I get access to my money anytime I need that money. It grows tax-free. It's protected against judgments and liens. And if I die tomorrow, my family's taken care of with a death benefit. All the reason I need. But here's the real reason. The money I put into that whole life, when I need to take that money out, let's just go back to the credit card. I got my money, not in a savings account, not in a bank account, but in a whole life policy. I then take a loan from the whole life policy and I pay off that credit card like we just did before. Let's just do some numbers. Let's just say the Visa was $5,000 that I owed. So I saved $5,000 inside the whole life. I took $5,000 out of my whole life, which is me taking a loan from the policy, and I pay off Visa. How much money's left in my policy after I took the $5,000 loan? I started with 5, I took 5 out. How much is left? Some of you are thinking 0, right? You're like, wait, you started with $5,000, you took $5,000 out, so you got 0. Wrong. I have $5,000 in my whole life, earning a guaranteed interest rate plus dividends, compounding uninterrupted. But I got $5,000 that I paid the Visa off. And then if I take the amount I gave Visa and I put it back into the whole life and I pay the loan down to the insurance company, I'm even making more money. I literally just showed you how to make, I showed you how to make money twice on the same dollar. Imagine if every dollar you ever saved got to make money twice for you instead of once. What would your life look like? That's just, I went a little long in that, but there's more to it, which we'll cover, but that's the fundamental. It's a process, not a product.
Perfect. And look, this is something Chris and his team, they help literally thousands of people every year with these type of accounts. I use it as a bank, and why I like it so much is it jives with my message about taking back control of my money. And it's two different types of money. Chris is talking about money that's outside of a retirement plan. This is the kind of money you put away that you can use. You put in the policy that Chris explained, and then you can borrow out against it, just like he said, and pay your bills, pay off credit card, whatever the case is. It's your own bank that you've created outside of retirement plan. The reason why this works so well with my message and our message about self-directing is it's also a way that you're taking back control of your money to invest in what you want and not pay taxes. And that's probably the biggest difference. When people ask me like, hey, I don't think I need a self-directed IRA because I have a whole life infinite banking policy. I can tell you it's apples and oranges. So those individuals that have a self-directed IRA are looking to put money away that they probably already have. If you already have a retirement account and you want to compound invest it and not pay taxes, that's what a self-directed IRA does. When you put money into insurance policy and then borrow out against it, and let's say you invest that money in something, if you invest it in something and earn interest on it, you're going to pay taxes on those gains. That's really the only difference. A lot of things that I do, I use my policy for paying off debts or buying a car and paying it back. So it's my own bank account. It's totally different. So I want to just make sure, and then we can go over some questions and answers kind of at the end to go back to this to clarify it more if we want to. But before we do so, I did prepare a couple little things. I'd like to share it with you on the screen. And so let's see here. Tell me if you can view. Can you see my screen?
Absolutely.
I already told you I'm not an attorney, CPA. I already talked about the self-directed IRA, the control and flexibility it has. What I wanted to share with you as well is those that qualify. If you're listening and you have an IRA or an old 401k from a previous employer, or a 403b or some kind of pension from a previous employer you've been let go, you qualify most likely to move your account, all of it or just part of it. You don't have to move all of it, part of it into a self-directed retirement account. And our team will help you. In fact, I know Claudia will put this in there, or someone on my team who's listening can put in a link while we're talking here. For those of you that want to learn more about your account, let's just say you're not sure what kind of account you have. Set an appointment with us. We'll go over it. We'll go over your account with you and explain to you what a self-directed IRA is. But in particular, if your account, if your funds qualify to be in a self-directed IRA. So I wanted to go over that. And I just, and again, 403Bs, 457, TSPs. For those of you that have one of these accounts or think you have one of these accounts, set an appointment. We'll teach you kind of how it works. And then after this, I want to share, these are probably where about 70% of our clients invest is real estate. And then there's other things on this list, and the list is really infinite, really, as far as what you can invest in. There's very few things you can't invest in. You can't invest in collectibles and arts. You can't invest in your own home that you live in or vacation home, but you can invest in flips. You can invest in real estate properties and wholesaling. I got a lot of people that invest in other and lend to other. I know Chris himself, he's going to talk about here because I've got a slide here next for him to talk about. I'd say most of our investors are actively engaged in investing in some kind of real estate. But there's Bitcoin, there's precious metals. I'd say in the last 60 days, I've seen more people invest in precious metals at our company than I've seen in the last probably 12 to 18 months. That is definitely on the rise with obviously the uncertainty of the stock market. Precious metals, it's a sit and wait kind of a game as well. And it's a more tangible thing. So I get it. A lot of people are doing that as well. So if you're listening in right now and you're saying, hey, look, this idea sounds new, it sounds interesting. First and foremost, it's been around since the 70s. We're a licensed, regulated industry. We're regulated and audited by the banking division of our state where we do business. We can accept accounts from everyone in all 50 states. If you have a retirement account, an old 401k, you qualify. And then we do not make those decisions of where you invest. You get to pick and choose. There's lots of a library of information of different places you can invest. I know something that Chris also can probably share as well. He helps, different individuals learn about their options as well. Before we do that, I asked, hope you don't mind, does any of this look familiar on this screen?
Let's see.
I didn't ask Chris if I could, kind of leak
Yeah,
it.
these look like some of my self-directed IRA deals.
Yes,
or maybe
it is.
Larissa's. Are these mine or are these my wife's?
I think they're your wife's. And so,
yeah,
sorry,
these might
Larissa,
be my wife's because they're
if-
smaller dollars.
If Larissa is listening, I apologize, but I know Chris, you can let her know that this is all for good reason here. This is real investments. Chris did not ask me to put this up there. I wanted to put this up there so you could see, like, Chris and his wife are actually doing exactly what we teach people to do. They've been doing this outside. Again, this is outside of the infant banking. They're using their qualified funds that they already had established and doing simple real estate investments. So, Chris, just because I surprised you with this list of your wife's investments, maybe that was the wrong thing. I probably should have done it for your investments.
Well, these might be mine. I mean, we invest in similar things. A lot of times, me and my wife will take our 2 IRAs and put them together to do more, either bigger investments or more investments. But lately we've been doing them separate. So I see a couple here that look like hers, but then I see a couple that are mine. So I think it might be a kind of a hybrid, or who knows,
Yeah.
but I've done so many deals with my self-directed IRA that I literally don't remember them all. But the one thing I do know is with my self-directed IRA, if I look at a chart from when I started, which was around 2015, straight through to today, it doesn't look like my statements do, when I was a advisor, or statements did when I was in a 401k, which are up, down, up, down, up, down. It's a straight line. That's the beauty. It just goes up. It's almost just a perfectly straight line. And all I've done is did what you said. The ultimate in real estate is being the bank, lending money. That's all I do. First lien position, and then that limited partnership one, which was an interesting one, but it's been an awesome ride.
I mean, this is the reason why I liked this. And again, thanks for, I'm asking for permission afterward, right? Is
That's okay.
I know you're a big proponent of this, and you share it already, and it's not even what you do for, like you don't own a trust company, but you share this message with a lot of your investors as well, and friends and family. And that Chris nailed it. If you're in that place, most likely in the stock market, you're experiencing the ups and downs. And it's funny because people get all excited about making 20% in the stock market. It doesn't happen very often, but when it does happen, all it was is gaining back the 20% they lost the year or 2 or 3 before. And so now they're at the same number they were 3 years ago, and they're all excited about it. What's typically great about this is you can invest in things that are more consistent, that you can control. And that's what I love. Or invest in somebody that you know. I'd rather invest in somebody that I know than some mutual fund guy, maybe who's just brand new, just, graduated or just got their license, and they're pitching just whatever makes them the biggest fees. What I like about this is you don't have to make these returns that are on here. This looks awesome, right? ROI 21%, 11%. Sure, that's great. But what my message, and I think Chris is saying it the same way and just a little differently, is if you can earn 8 to 12% every year and consistently do that in the right trajectory, you will way outperform not only the stock market, but almost anyone else investing. And believe it or not, that actually 8 to 12% consistently compounded, meaning you're earning profits on your profits every year inside of your retirement account, will mean you'll most likely have hundreds, if not millions of dollars more in your retirement account because you're doing it the right way. And just like your vehicle, when you talk about whole life insurance policies, this is a vehicle. That's all this is. The IRS has approved this. The rich are using it. And frankly, more middle class, more people need to be using this type of vehicle and just aren't aware of it. They don't know they can be lending, $30,000 on a note and earn 10% or 12% or 11%. They just don't know it. And the reason people don't know about it for the most part is advisors either aren't aware, which is definitely the case, or advisors, there's no compensation for
There's
them.
no compensation for an
There's
advisor.
no
Most
reason
advisors
for them to be
can't
like,
do
"Hey."
this. Yeah, they can't because
they
it's called
can't.
selling away. Like I wasn't able
Yeah.
to recommend self-directed IRAs, not because they weren't good for my clients. You know, I 16 years I was an advisor. Never once did I do a self-directed IRA. Never once did I have a problem with them, but it was called selling away because my broker dealer couldn't make any money on them.
Yep. I mean, so it's those are typically the thing. And look, only 4% of Americans self-direct. And our message today is not to say that 100% of Americans can do it. In fact, I only think probably 15% of Americans should self-direct. Why? Because most people don't take the time or the energy to actually do due diligence and know where to invest their money. Most people like to just like they get their paychecks or W-2s, they want to work from 9 to 5, get their paycheck and put it in the stock market like their grandparents and parents have done for years and years and do the same old thing. That's okay. This is not for everybody. I do feel like most people that are listening or events that we go to, it's mostly typically for them, because if you're listening to this, doing other education, reading books, trying to be more, getting better returns than you have been, the last decade, this is most likely for you. And the other thing I said once before, and I'll say it again, is you can tippy toe into it. You can say, hey, look, I have a $100,000 IRA. I'm going to leave $50,000 with my advisor. I'm going to take 50,000 and self-directed. And why don't you make it a race, a competitive thing with your advisor? See who can do better in the next 12 months and see if he can earn or she can earn your business to stay there or go back there. And so
They won't beat this, Greg. I'm sorry, they won't.
yeah,
Maybe
most
one
likely,
year, maybe 2 years, but not consistently. It's not, it just can't happen.
yeah, it's not typical, for sure. And so, look, our goal and our message, and we're going to get to some questions and answers here for a bit of time here. I want to talk about kind of other things that people are doing, but I wanted to first show what Chris has been doing, and also lots of his. I've known a lot of your followers who also have worked with us who are investing. I know, like I think there's that Rob's one of I
Yeah, Rob
think
Fuller.
what's his last name? Sorry.
Fuller.
Fuller. I've seen a lot of people investing and lending to these experts that are really good at real estate. And look, I'm not pitching anything, but I will tell you, I'm in the same boat where I don't want to be flipping with my IRA. I love lending. I love someone else finding the deal, rehabbing the deal, dealing with legal, cities, permits, whatever the case is, and I'll just lend. Because typically, what I've learned over all my years of flipping is the lender makes almost the same amount of money as the owner, and the owner's got to put a lot of time and effort into it. And look, Chris started out with something I think critical, where I've seen my success as well. Is I dropped out of college. I'm not the most educated by any means. I just felt like I worked harder than everybody else around me at the time, and I also took advantage of vehicles and tools that are readily available. And I think if you just understand the rules and understand the different opportunities and work a little bit harder. Now, what does that mean? When self-directing, I think that just means spending a half an hour a month, 30 minutes a month, paying attention to your investments. I would bet all that I have that most people plan, I'd say most meaning like 90% or more, spend more time planning their next vacation than their retirement. And really, I'm talking about a half an hour. That's 5 to 6 hours a year planning for your future. And that's how I feel like if you can spend a little bit of time, be engaged, educate yourself, know your options, start earning profits on profits and not paying taxes on it. It is a game changer. Literally, it's the difference you having a $500,000 or $1.5 million when you go to retire. And that's a big difference. Living off interest at 10%, you're going to get $50,000 a year or $150,000 a year passively when you go to retire. So it's a big deal. It's been a life changer and a lot of fun for me. So that was that slide, Chris. Thank you. I only have one or two more slides, and then we'll go back to kind of talking a little bit, answering some questions. So, and like I said, stick with us because we got a gift for me to give out as well. So for those of you listening that are new to self-directing, it's a very simple process. You can see it right here. You fill out an application. We request your money to be moved over. It's called account funding. So let's say Chris has an account at Fidelity and he opens up an account with us at Horizon. He then has money from Fidelity funds into his account at Horizon Trust. Now it's funded. And then once it's funded, there's a simple form you fill out. It's called a direction of invest form. You submit it to us with a contract. So basically it could be a loan, a promissory note, or an LLC, or a note recorded. And that document you send over to us with the DOI telling us at Horizon Trust to send your money to title or to whatever entity for your investment. We send the money out, funds are sent, and that is the process. Now, the only part of this process that I need to re-loop in here is when the deal pays off, when there's profits or dividends or interest, that money and principal will go back into your account. It's circular. And so you can't obviously pay it out to yourself unless you're 59 and a half. Then you can start taking distributions. So before I actually, no, I should do one more. And Claudia's on with us too. And I'm going to bring Claudia if she's listening. I think she is. Claudia oversees really all of our new business coming in. And Claudia, you there with me? Maybe she's not. I caught her off guard.
Yes, I am.
All right. All right. So Claudia, you've heard us, and Chris are going to go to some kind of questions, answers, and kind of talk more about banking and taking back control of money. But before we do so, is there something I missed? Because Claudia usually lets me know afterwards if I've missed something, and I can do a better job. So, and look, Claudia also, there's your face. That Claudia also, has the ability and an opportunity, frankly, to see so many people opening up accounts and using their IRAs and self-directed. Almost every account goes through your division. So is there anything that I missed or that I could better clarify or that Chris and I missed on this subject?
I don't think so. There's some good questions that I fielded that I'll go ahead and ask you guys. And they're pretty divided, one for Chris, one for Greg kind of thing. So I want to go over those with you guys because I want everybody to have a clear direction. You can have both vehicles. It doesn't have to be one or the other. They're very different and they're both very, very enticing. So it's important that everybody's very aware of the differences.
Yeah, I think we're going to hit on that here for the next little bit. And before I take this screen off, I wanted to put this up there, and Claudia will put it in the link as well. There's a link you can click on and schedule an appointment. But if you don't want to do the link, you can hit this QR code or send me an email. That's my email. We respond to everything within 24 hours. If you have questions like, hey, look, before I set an appointment, I want to understand, if this account qualifies, shoot us an email, shoot us a question, or set an appointment with us. We will help you establish a retirement account, a self-directed account, and then show you also kind of what your options are as far as what account is best for you. So again, there's a QR code. We'll send a link as well. And there's my email. And I'm going to come off of this, stop the share here. There we go. And so, before we go to some questions, Chris, would you disagree or explain it differently? The difference between a self-directed IRA and the infinite banking policy, because sometimes it's nice to hear it from a different perspective than how I shared it, or maybe I just shared it perfectly. How would you explain kind of the differences and why they're both good and how they work, just differently?
Well, they're both taking back control of your money because you are being put in control of where you're putting your funds and how that money is being earned. I think the biggest difference is with the self-directed IRAs or anything qualified plan related, you are bound by the rules. So there's a lot of governmental rules and a lot of IRS rules that you need to follow. 59 and a half withdrawal, provisions, 10% early withdrawals, things like that. With that, we're in the private banking side, the infinite banking side. It's all non-qualified funds. So none of those rules exist, but they're literally like, why do I have both? People would wonder like, well, why do you have a self-directed when you do infinite banking? Well, because at one point in my life, when I worked in Wall Street, I had a 401k and I put money in it and I got a match. And when I left Wall Street in 2018, well, actually it was before that I moved it. But when I left Wall Street, I didn't want any money in qualified funds. So I moved it all to self-directed. And so did my wife from her banking. So we bank, we're our own bank from the self-directed IRA side, which you showed some of our transactions. But then on the other side, that's the majority of where I put money. But the other biggest difference is in a self-directed IRA, when you've got money in there and you take that money out and you invest it, you're making money one time. In the policy, you're able to make money twice on the same dollar because of the same reason banks make money. It's a spread. The policy pays you interest and dividends on your money, but you still get to use that money and make money a second time. And this is where I know Amy was like kind of saying a couple of things where I didn't quite get into it. Uninterrupted compounding interest is the key for why the whole life is used. Because when you take the money out, although you're taking a loan, you're borrowing your death benefit while you're living, and your money stays in your account earning interest and dividends and only serves as collateral. which is different than with the self-directed, because when you take money from the self-directed and you, let's say I lend it to Rob Fuller, that money went one place, went to the Fuller. So Horizon isn't paying me interest and the Fullers are paying me interest, where in the policy in the infinite banking, the insurance company is paying me interest and the Fullers are paying me interest. And I get to, I get to make money twice on it. So that's the simplest, way. And I probably
Yeah,
confused some
I
people
think
saying that.
no. I think that was good, and I'd say, and I'll just add on that example you gave when in the difference with self-directed. When Rob Fuller pays you interest, you'll pay taxes on some of that interest. That's outside of the insurance policy. So when you're self-directing, the reason why we both have both those accounts is we have retirement accounts, and we want to be investing it in whatever we want and deferring the taxes or not paying it at all if it's in a Roth. So that's the power. So when you're able to not pay, like if I'm making 10%, but having to pay back 2 or 3% every year in taxes, it's a net of, 8 or 9%. But if I'm making 10 or 11% and not paying taxes and compounding, that extra 2 or 3% every year that you're not paying taxes on, believe it or not, is hundreds of thousands of dollars difference. And so that's the powerful part of using a retirement account and using both
100%.
things. And so I'm a huge, fan of it. I do it. My son does it. A lot of you might even have met my son. I remember calling Chris a couple years ago. Was it maybe a year and a half is all ago? And I was like, "Hey, Chris, I love what you do. Would you take my son was like, hey, I'm going to work with you. I was like, no, it doesn't really work that way. You're not going to work for me till you go work for somebody else and see how terrible it is. Unfortunately, it's not terrible with Chris. He's loving it. No, I'm joking. It's exactly what I wanted and hoped. I said, look, you got to go earn it on your own. I said, you're gonna have to interview with Chris and work, if Chris likes you and if you can follow his system. And Carson now has been, I think, working with you for 18 months and not for me. Now the problem I have is whenever I sit down for dinner, and he notices I bought a car or bought something. He's like, Dad, did you use your policy? And I was like, dude, just chill for a minute. Like, and he's like, no, you got to use your policy. And so, anyways, it's part of my, as you guys know, some of you that test there, I appreciate. Yeah, Carson is my son, and he's well beyond his years from where I started. But it is in my family now, and so it's really fun. Carson has a self-directed IRA, and I've seen him using his self-directed IRA doing different deals. I mean, so you can and should be doing both these things. So in fact, why don't we move over to some questions and answers that you've got here, Claudia, and Chris and I'll take some stabs at it, if that's all right.
Yeah, absolutely. So a couple of questions. Somebody wants you to go over the difference between Roth funds and traditional funds.
Cool. Yeah, that's a great question. So the biggest difference between a Roth and a traditional IRA is when you're going to pay your taxes. And the example I like to say is, do you want to pay your taxes on the seed or on the crop? What does that mean? If you have 5,000 or whatever the number is, let's say that I want to start a Roth IRA, and which means I put in $5,000, but those $5,000 is after I've already paid taxes on those $5,000. That means I put it into a Roth, already paid the taxes on it. I don't get any tax benefit credit to this year at all on it, which then means I've paid the taxes on it. So that $5,000, that seed is going to grow up to be whatever, let's say $100,000, $1 million, whatever that dollar amount is. And I go then to take it out after 59 and a half. I then get all of it out tax-free. I don't pay any taxes. The difference of a traditional account is you don't pay taxes on the money up front, meaning you put money into a traditional and you get a tax credit today, but therefore it's going to grow tax-free. But when it comes out, you pay taxes on the whole amount, the $100,000 or the $1 million. So it just depends upon when you're looking for the tax benefit. I recommend most individuals to have a Roth if you can have a Roth. If you don't qualify, there's actually ways you can qualify by using a 401k if you're a business owner. So there's lots of creative ways of doing that and putting more money away than you might be aware of. And so I always recommend a Roth over a traditional, but many of you might already have a retirement account. You're listening, you're like, hey, I've got a traditional or a SEP or a simple, and it might be, let's say it's $100,000 or $200,000. You might not want to pay the taxes on it right now and convert it to a Roth. Conversions of traditional accounts is a whole different subject. I won't tackle it unless someone has some more questions about it, but we help a lot of individuals move their traditional account over to us that he can convert some of it or none of it, or all of it. So hopefully that explained the seed or the crop as far as the Roth or the traditional account.
Thank you so much. Somebody's asking, can the profits from the IRA purchase a whole life insurance policy? Can they use that?
There is a technical way that retirement accounts can purchase life insurance. It is very technical. And Chris, I don't know if you want to disagree with me on this one because you know insurance way better than I do. But the answer for the most part is no. There's hardly any cases in which an individual can use their retirement account to buy a whole life insurance policy. Chris, do you change?
Yeah, I mean, there are ways, like you said, it's technical. I mean, you could do the equal substantial payments throughout your lifetime and take those out and drip out your IRA to fund the policy. But I would just not find that as advantageous. You might as well just keep your qualified funds qualified and your non-qualified funds non-qualified, and just do kind of what me and my wife do and what you do, Greg, is just treat them separately and get the tax advantages of keeping them in that qualified plan.
Yep.
Thank you. Okay, somebody's asking, can one roll over a 401k into the infinite banking system? That's what we just went over.
No.
Can we do same stuff with self-directed IRA versus solo K? Because I have a solo K. Also, is the life insurance a completely separate concept? So we went over the separate concept, totally different, and then the difference between an IRA and a solo K. You want to go over
So
that?
if you have a solo K and it's not self-directed, it most probably is self-directed, but you can do the same things. When I say the same things, you can invest in the same kind of assets as a traditional self-directed IRA or a solo K. What you invest in, the options are the same. The rules of the vehicle are different, meaning the rules of a traditional account, the IRS rules of what you can do and how much you can contribute are different than a solo K. In a solo K, there's a much bigger opportunity to contribute a lot more to your solo K, but also take out a loan. You can't take out a loan against your IRA. And so those are probably the two major differences between a solo K and a traditional. But what you can invest in is the same. You can invest in the same kind of assets.
Yeah.
Perfect. I have a good question for both of you. I want to see what you guys answer. It said, what would be the rate of returns on average between self-directing if I could only invest in one? So between self-directing and infinite banking. Would it be more advantageous to do infinite banking if I am healthy or self-directed? I do not want to take much of a risk, but if the average ROI is self-directing is 8% to 10%, then is that better?
That's a
That's a
tough one because I don't think it's a,
multifaceted question.
yeah. Chris, you can take a stab. I don't know. Maybe we're a little biased on that one, but you want to take a stab on that one, Chris? Because I
I
think
mean,
it's apples
the
and oranges. I don't think
it's not.
not one or the other really.
And the returns are really up to you. I mean, listen, like from my policies, I invest in treasury bonds, which are guaranteed by the full faith and credit of the US government. And then from my self-directed IRA, I could also invest in treasury bonds. So from that standpoint, they're equals, right? We're investing in the exact same asset class. One, I'm putting money in the policy, then I'm taking a loan from the policy and I'm investing it in treasuries. And the treasuries are kicking off an interest rate that I'm then rolling back into the policy as a loan repayment. And I want to make sure I hit Amy's, it's a circle. And over on the self-directed, I'm investing in treasury bonds. The interest is then paid to the self-directed IRA. So really they're the same from a return standpoint. It just depends on what you invest in. The difference with the infinite banking is over time. The one thing I get to do with the policy is I get to compound my money while using it a second time. So I get to save and spend or save and invest at the same time. So over a long period of time, I would always say that not factoring taxes in. Okay. So we got to leave taxes off the table, but I could probably over a long period make more in the infinite banking policy simply because I get the interest from the insurance policy compounding every year for the rest of my life. No ifs, ands, or buts about it, even though the money's invested in treasuries or private lending or stocks or gold or whatever I want to put it in. So I know it's kind of a complicated thing, but really the return is irrelevant. It's the vehicle and the reason you have the money in the vehicle that matters.
Yeah, and look, I'll add to this, and this shows you I'm not biased, because I would say if you're just starting out and you don't have either, and you have a little bit of money, I would agree. I think you'd open up an insurance policy and create your own bank. That's probably the first step I would take. I would say for those of you listening that have a retirement account already, or an old 401k that you're like, oh, I don't even know what it is or what it's invested in is $15,000. Don't ignore that. The message for self-directing for the most part is for individuals who already have a retirement account who want to take back control of it, invest in what they want. So if you're listening and already have a retirement account, absolutely should be self-directing for the, well, I shouldn't say absolutely, most likely should be self-directing. For those of you who don't have either and want to start somewhere, I do think a great place to start would be the infinite banking if you're healthy and you get a policy. And then look, you can, I will tell you how it can work together, is you could fund a whole life insurance policy, let's say for whatever, $7,000. You could then borrow that $7,000 and create a Roth account. You could do both things. So now your Roth self-directed IRA account is set up, and you'll just start making payments back to your whole life insurance policy on the $7,000 that you borrowed. So you can actually do both with a little bit of money. I don't want to get too complicated here. Hopefully it's not too confusing. And look, and I got to preface this again, set an appointment, go to the link. The link's been in the chat. Set an appointment and we can explain and talk to you about how this might work best for you based upon your age.
Yeah, it really does depend on your situation. Something that I did is I set up a 401k and I actually had to do some tax deferring that year. So I put in a large contribution. Then I took it out as a loan. I put it into my policy. Then I took that out and then I put it back and I paid my 401k.
Love that.
So it was my
Claudia.
first year.
Go Claudia. Look
A little
at
bit more
Arthur told
advanced.
me.
I wasn't going to go there, but that's absolutely a way you can do it. And that would work really well.
Yeah. So it just depends on your situation. It depends what you're trying to do for the year. It really, there's a lot of strategies that you can use, and I've used them, and they're really cool.
Yeah, that's a good one.
What is the best way to go look into best life insurance policies? So, Chris, how can we get a hold of you?
Again, I want to warn you, like, you're not looking for the best life insurance policy. Everything that we like, these policies that we're talking about, they're not off the shelf. You're not going to call an advisor or an insurance agent and be like, hey, I want one of those infinite banking policies. They're not even going to know what the heck you're talking about. To build these policies, it's like a mad scientist. We have to engineer the policy contract to work for the infinite banking concept. It's built backwards from life insurance. We put the lowest death benefit on, shove the most amount of money in under IRS rules, which are called the Max 7 pay rule, to make a policy that's incredibly efficient, has lots of cash to use, and grows very consistently and very efficiently over time. So you're not looking for the best insurance policy. You're literally looking for the best person that knows how to build the policy to solve your problems. Listen, there's no magic machine or vehicle out there. I got bad news for you. Like, all these products, all these things, there's no magic one that's going to make you wealthy. But one thing that will make you wealthy is figure out what your goal is, figure out what the problem is you want to solve, and get the right strategy that solves that problem. That's how you'll build wealth. And I always tell people, you want to build wealth, the fastest, easiest way, it's through your debts and expenses. You're giving up all your returns to somebody else's bank. Take back that control of that money. That's the banking functions. And that's the first place. I love it when people are like, I've got money. What do I invest in? What's the best thing to invest in? Well, there's a lot of great things to invest in. But first, let's figure out where you're leaking. Like, what's the problem? Well, I've got these credit cards and I've got this car payment and this boat payment. Whoa. Let's not invest any money. Let's take back the money you're giving away first, because that's your safest, best return. And then from there, let's build on that foundation, because debt is what sinks all ships, especially in a recessionary period. You want to go down during a recession, have a bunch of debt going into a recession. That'll be the end of it, and you'll be starting over already. So that's one of the biggest fundamental things I always tell people is stop thinking that there's a magic investment. Stop thinking that Bitcoin's going to go to the moon. Stop thinking that one thing is going to make you wealthy. It's the consistent, persistent action that you do to solve a particular problem or goal that's going to make you wealthy. There's not one thing that's going to get you
So
there.
I'm going to add to this, and I'm still a rookie on this. I'm not as an expert in this field, but I know it well enough to see that when people hear about this concept, about using insurance policy, one of the first things they want to do is call their insurance agent. And tell them they want to get this policy. And what do the insurance agents say? Yes, I got it. I'll do it for you.
Buy an
But then-
IUL.
but the problem, and I know this to be the problem, is I understand how commissions work. These policies have very, very little commission. And the reason why they have such low commission is because they're built for you, the client, to have access to the money you put in there. And so I've seen people say, "Oh yeah, I can do the infinite banking thing," and these agents will just write a policy for a high death benefit, like Chris just said, and cash value. It's a strange cash value. You don't get all the cash value that you think you should be getting, or that you should be getting. And the commission's huge for these agents. So they're like, "Oh yeah, dump in $100,000 and they get this big $25,000, $50,000 commission." These have
Absolutely.
very little commission. And that's how, and so again, we're probably going longer than we need to on this question, but that's why I know, look, Carson he probably sells, I don't know, my son, 50, 60 policies a month.
Month.
And he makes a good living, but if you go to a regular life insurance agent and he would sell 50 policies in a month, his regular policies,
Be
he would
making
probably be
over $1
making
million.
like
He'd be making well
100,000
over
or
$1 million.
$1 million a month.
He would.
Yeah,
He would.
so
If he was
it's
a
just-
regular agent selling regular policies at the volume he is, he'd be making over $1 million. And but the client would lose. So
The client
Carson
would- the
gains, client loses.
the client doesn't have the access to the cash value if they go with the typical. So I really want to preface this, and I'm not in the industry. Be careful if you want to get into it. And look, again, you can put in the chat, and Alex may put my email in there again, Greg Herlean at Horizon Trust Company. For anyone that wants to just, hey, I like that infinite banking thing. Our team will connect you. I'll connect you with Chris and his team, and they can answer questions on that subject. Anyone that wants to know more about it, just email me. I'm going to personally connect you with Chris and his team. They'll answer questions for you, and we'll go from there. And for those of you that want to email me or set the link to learn about their IRA account, same thing. Just go send me an email saying, "Hey, look, I got a retirement account. I'd like to know how it works," and self-directing it. And send me an email or go to our link. So I do think I got a hard stop in 5 minutes. So, and Chris, you're always good about this. It's probably snowing where you're at, but and it's later. But I appreciate those sticking here with us. And so there's a couple more questions, Claudia. But also respectful of people's time. I do want to give away a gift right now. And so we're going to give away. We've done this once before, and people like it. So we're going to give away a free LLC. So anyone here that wants an LLC, and I'm going to have Chris pick a number between 1 and 300. So actually 1 and 300, 1 and 313, and pick that number. And then that's the person, Claudia, will look it up, and that's who's going to get a free LLC today. So go ahead and pick the number here, Chris.
13.
Wait. Let me bring up my participants because I need to.
He said 13. So the 13th person.
Lucky number.
13. Oh, that looks
That's
easy.
my lucky number.
Alex, if you can look at it first. I don't know how to bring it up. 13.
Come on, where did this suspense?
I have a couple people saying they need an LLC. Let me get Alex too. I can't click on the participants.
All right, we're gonna come back to that in 1 minute. I'll let Claudia keep. Well, actually, Claudia, can you give us the next question here while you figure out who number 13 is? Look, she's so official. Like she's like, it's not going to be number 14 or 15. It's got to be. I like that.
Yes, I actually have a good question from an anonymous attendee, but he has a good question. So it says, if my annual income is 300,000 plus, would you still recommend I invest in a Roth 401k versus a traditional 401k? If so, why or why not?
I always will recommend, I don't know your age, Anonymous, but I will almost always recommend a 401k with a Roth account. It doesn't give you, like I said, as much tax benefit today, but if you have, 5, 10, 15 years of growth ahead of you, which most likely you do, then setting up that account and contributing it. And that's one other thing that whoever asked, that's a great question, and most people don't know, is if you make that much money, typically you cannot actually invest in a Roth because you make too much money. But if you have a 401k, that we can help you establish a 401k for your business, and you have an LLC, we can help you establish a retirement account, a 401k with a Roth bucket or Roth account in there, which allows you to contribute a lot of money, almost up to, I think, $62,000 into a Roth account. Then it grows tax deferred and comes out tax free. So it's a big deal. Great question. Did you get number 13 yet?
I did.
Okay.
Alex sent it to me. He said Owen McManus.
Owen McManus. So if you are on here, send me an email.
If you're on there.
Put your, well, you don't have to put your email in there. You can well, how do you want
to just say I'm here. Raise
there
your hand.
Congratulations, Owen. So make sure you Claudia will get with you and we'll get you a free LLC. We appreciate you. And I know we have contacts too for LLCs on a side note. Like we've got a lot of our clients that need LLCs for their 401k. So if you need something like that, someone mentioned it, obviously you can put it in the email as well in the chat, put your email or email us and let us know. That's not what we do, but we can help people get that done. So do you have any other questions before we wrap up here in the next couple minutes?
We have a lot of questions, but I think what we're going to do is please book an appointment. Send an email to Greg. He looks at it right after this, or in the next 24 hours. So definitely send us an email. I know that we didn't get to all the questions. It's impossible because I have a lot in the questions chat. And if you need to get a hold of Chris, he just send an email to Greg as well, and we'll go ahead and send it over to Chris's team. I'll send it to Carson.
One other thing too, Greg, when you were talking about like the reduction in commissions, I've got hundreds of videos on my YouTube channel at the Chris Naugle, and one of them is how I lost 534,000 on the infinite banking concept. That's a clickbaity title, but what it does is it shows you how that year I gave up $534,000 in commissions designing policy so that the clients had high early cash value, and it explains it. So like, that's the reason most people don't know about this, is because they have advisors, agents that don't either know how to do this or just simply, I don't know, ask an advisor to take a 90% reduction in their income just so that you have 90% more money. Will they do it? The answer is typically no, but they won't tell you that. So that's the fact. And IULs, the reason they're so prevalent in the market, I got to hit this one, is because they are the highest commissioned product in the financial industry, and it shifts all the risk from the client, or I'm sorry, from the insurance company to the client. Whole life puts all the risk on the insurance company, not the client. So when you start thinking about why you always hear about buy term invest the difference or IULs, always think those are the two most profitable insurance policies sold by all insurance companies. So it's not what you think. It's Will Rogers would say it. The biggest problem in America is not what people don't know. It's what they think they know that just ain't so.
Yeah. I think that's where we end tonight. I think that was a perfect way to end. Look, Chris, I'm going to have you back on soon. And again, it's always just a pleasure to hear from you. We don't get to talk as much anymore because you're so busy, and wanted, and you're just doing a great thing. It's so fun to see what you're doing and the lives you're changing. So thank you for being here. Again, if you're on here, we're a community. We are a family, a boutique firm, both of us, really. It's really about serving you, giving you as much education and tools so you can make your own decisions. So appreciate you taking the time tonight and being with us tonight. And we'll talk to you guys soon. Have a great night.